Bonjour. I hope everyone enjoyed and appreciated the talk of Gianni. Sorry. Our project is a lithium project, and I'll run you through, and it's highly related to the presentation that Gianni did a bit before, so the usual disclaimer. This is a slide that expresses maybe the back end and the commitment of the automotive industry that just went up in the last 18 months. 5 years ago, lithium was a vision. There was sufficient production worldwide controlled by Rockwood at the time, FMC and SQM, and further along with Tianqi out of China. And that was about 90% of the global supply out of those four producers, totaling about 200,000 tons of lithium carbonate equivalent per year, was sufficient to cover the worldwide need of lithium. What became firm in terms of growth in the commodity was announcements that were done and signed contracts in 2016 by the German automotive industry, companies like Daimler, BMW, Volkswagen, and mostly in China. If you want to have a license plate in China and you want a combustion engine, your waiting list to get a plate will be more than 18 months now. If you want an electric car, you'll have it instantly. So that's the market, and that's the extension of the demand. To meet emissions out of Europe for Volkswagen, after especially the Dieselgate, they need by 2025 to have 25% of all passenger cars to be electric. That means 1 car per 4 cars sold. This is a chart that illustrates how much lithium that represents. So you have market penetration per cars by percentage and the years. The broker analysts estimate average about a 10% penetration by 2025. Canaccord estimates about 15%, which represent 600,000 tons of lithium carbonate equivalent. What Volkswagen, BMW, Ford are pushing for is 25% market penetration. That equals 1.2 million tons of lithium carbonate equivalent. What this means, current producers announce already, and they are close to capacity in most of their assets, 150,000 tons of additional production. We need at least 10 projects like this one to come into production within the next 7 years. This is the math you need to look after. And if you say, well, there's tons of lithium in Argentina, tons of lithium in Chile, well, there's capacity limits of pumping rates at Atacama, which are reached already, and Atacama can only increase by 25 to 30,000 tons. Here's the limit. If they pump harder and they've tested, the lagoons are going down, and environmental impact repercussion are not allowing that. This morning, Orocobre out of Argentina, which share the same solar of Lithium Americas, just announced stop of production because of high intensity snowfall. So what we are coming to the industry is a reliable source of supply with a hard rock deposit, with a simple proven technology and simple open pit mining in Quebec. So, and what we have also in the last few years with this special deposit that have special feature of purity and impurity profile without requiring of higher purification process, we've been able to attract the best of the industry. And when you look at this, today Rockwood no longer exists because it was bought over the New York Stock Exchange for $6.2 billion by Albemarle. So Albemarle today controls 60% of the world active reserve of lithium, especially at Atacama and at Greenbushes in Australia. Stefan Haber was the CEO and president of Rockwood Lithium. Marcus Brune was the CFO of Rockwood Lithium, and David Buckley was the Chief Processing Manager of Rockwood Lithium. So our asset attracted the best of the industry in the lithium world, with guys that already did it. We have as well a proven local mining team that executed different discoveries through production, because the lithium business doesn't belong to the mining space, but it truly belongs to the chemical space. Our strategy to the market: you need to build a mine, and you need to build a chemical plant to supply the battery market. Doing 10 different things at the same time is really highly complicated, and unfortunately we only have one Stefan and one David. So we cannot duplicate talent, and it's a very limited talent available in this market. So what we're going to do is we're going to split the production phase by coming with a phase 1, with the production of spodumene concentrate and tantalum entering into early cash flow as soon as 2019 and 2020, and come with a second phase to convert our spodumene concentrate into the lithium chemical carbonate. Therefore, the deliverables for the company is we're targeting the delivery of our feasibility in the first half of this year, which should come in the next couple of weeks. We'll probably try to avoid 1st of July and 4th of July, so you can count on the next maybe 3 weeks for that. Permitting is already started, and we're about to post our environmental impact study. Construction we're targeting for Q4 2018, and the ramp up of production 2019-2020. The first phase will be constituted of 50,000 tons of technical grade spodumene concentrate. This product is the highest upstream value product in the entire lithium products that you can produce. 175,000 tons of chemical grade spodumene concentrate that is dedicated to the battery market, and 200,000 pounds of tantalum byproduct, which is not necessary for the project to be economical at all. It's less than 5% of the revenue. This will cost approximately between 220 million to build, US dollars, and we're targeting an EBITDA margin of about 100 million. Second phase will start to be built in 2019, to be delivered in 2022 and operated in 2023. And the only difference is the 175,000 tons of chemical grade will be converted into the 24,000 tons of lithium carbonate to the battery market. Okay? So for 2-3 years, we'll sell a concentrate, and then we'll turn into a chemical company. Phase 3, a chemical plant is about 30 years of life. So we have about 17 years of mine life here. So phase 3 will be to increase that, and we definitely have the legs to do it. By doing this two-phase approach, we minimize CapEx, we enter quickly into cash flow, which are robust cash flow, and we sell a very predictable and reliable product rather than the South American. Those are the products. So this is the technical grade. After roasting in a kiln oven, you can see there's no iron oxidization. This is the same type of product, but you can see there is definitely iron in it. The difference in quality is huge, and especially into pricing. The market for the technical grade spodumene is something that you use every day as Corning ware glass, Pyrex, heating cooktops, saran, stuff like that. Nobody knows, but it's a third of the global market. And this market is poorly served because of the presence of iron in the majority of the pegmatite deposits. The global market is about 500,000 tons a year, right here, and it's only served by Talison out of Greenbush, Australia. The capacity of Greenbush is 90,000 tons. So where comes the rest? You cannot extract the iron from here. You can only extract it if you convert it into lithium carbonate. Therefore, the glass manufacturers are taking the lithium carbonate, they're adding some sands, some silicas, and so on to the recipe, and it costs them much more. So the material of choice is the technical grade, but they only serve from 1/5 of their total demand. We're not replacing any, we're not competing against any spodumene. They're welcoming us. We've tested our material with 8 major manufacturers through Europe and Asia, and the product is already qualified and spoken for. This is a cost of about $300 a ton, and it sells between $1,500 to $1,800. The other stuff, we don't have the low iron spec on the entire ore body. Our second zone is the chemical grade spodumene concentrate. Australians are selling 5.0 as a benchmark, and it sells for about $800 a ton over long-term contracts. We have a 6.2 to 6.8% concentrate. So much higher concentrate value, should sell around 1,000 to 1,200 over long-term contracts. This, you need about 8 tons of this material to do 1 ton of this lithium carbonate stuff. And the lithium carbonate right now, long-term contract by SQM, which is usually typically a bulk commodity company, sells between 10 to 20% lower than the other companies that can reach pricing excellence by breaking down customer repackaging, which is the case for critical elements, and I'll show you why later. They sell for $12,000. Current best of class right now in the lithium space sells for about $14,000 a ton. Our position, if you look in Quebec, Montreal would be right here, project is right here. We are a dominant landowner in the lithium district. Galaxy out of Australia, which is an upcoming ramp-up producer, is about 150 kilometers from us. Nemaska is right here, and our main asset is right here in the Texas shape form claims. We have all the extension of Nemaska. This is where we have the Rose. We have 17 years of mine life. We have a new discovery right here that average grades of 2%, which will be highly investigated shortly. We should have a drill rig in the next 2 weeks there that is totally carried interest for us by a joint venture partner that we have out of Australia. So we're not spending a penny, and we're carried interest until feasibility. We have a 2% royalty on their 75% interest, and we have a right on the products. You can see on our main asset, the lithium outcrop surface, the power line is directly on site. We have 3 power lines surrounding the deposit, and it's really a surface deposit. We have as well the First Nation agreement in place. This is as well another advantage of being low impurities. Low impurities means less filtration. Less filtration means you lose less material. So this is from the first phase here. So open pit mining, crushing, grinding, the magnetic separation removes the loose iron in the deposit and the tantalum byproduct. So by removing the iron, we have a byproduct that comes out with it. So that's our first revenue. The mica removals, where the Australians are struggling mostly, and the concentrate production, all of this is by flotation. So no technology, no black box, we generate a clean concentrate, and therefore we have already a revenue stream right here. Then we build a second plant. We have the highest recovery of the entire market because of the low impurities. The average yield overall from open pit mining to lithium carbonate is around 60 to 65% in the best in class. We are at 81%, and we've posted 3 years of metallurgy, full disclosure, with all the pilot plants result. Nobody in the lithium industry did that. We wanted to put pressure for investors to understand that this is a special asset. On an NPV base with $10,000 or $10 a kilo for lithium carbonate, it would be a $1.4 billion NPV. I would moderate those numbers because this is at a par dollar US. Now, Canadian dollar is largely undervalued to the US, so CapEx at that time was estimated lower, but the commodity increase in Canadian ratio would make it. but it was a global integrated lithium carbonate buildup. So it was not a sequence two-phase project, but it gives you a sense of valuation. The IRRs are very, very strong. We have an offtake partner. It's a German company, privately held, out of Hamburg, a father and a son. So only in Europe you get those kinds of business still. They make about 7 to 10 billion euros a year. They are a specialty chemical distribution company. The way they make their money is they really focus on 60 different products. They were highly tied up with Rockwood Lithium, so you can see therefore an association. Stefan worked with them a long time. They've been 20 years in the lithium distribution, and their goal is to reach price excellence. If a company like Critical Elements wants to tackle the world with lithium products, you will need to build warehouses, local sales team in Asia, same thing with Europe, and be just in time for the small, very high-tech battery manufacturer. Then your SG&A goes up to the roof. What we've decided is Helm is into 31 different countries, 100 offices, all the infrastructure in place, and they've committed for 25% of the CapEx to earn 25% of the project. So if you look at Critical Elements, we are almost spoken for all the equity we need to build this project. The next step is to put the feasibility, get the debt inside the project financing, and go towards production. Helm has a solid balance sheet with $1 billion in cash and is totally capable of doing this check. This check will come 60 days after feasibility. Also, Helm provided us $4.5 million to complete that feasibility, and also they provided all their technical expertise on the chemical side with 2 project managers. One was for Dow Chemical, lead project manager, and had 400 employees. So as well, we have a good team of people to build a chemical plant and a local mining team to build the mining operation. I think it covers it well. Financial information. We have 160 million shares fully diluted. Basically almost no warrants. The only warrant holder of significant would be Helm at this stage, with 3 million warrants at $1.07 and 1.5 or 2 million warrants at 77 cents. The rest is all got exercised in the last few weeks, which were about 35 cents and was mostly the overhang on the stock. We have one significant institutional shareholder, which is JP Morgan Asset Management. We management fund most of the development of that project between the year 2012 to 2015. JP Morgan gave us $6.2 million in 2016 with Helm to give a treasury of $10 million. We've always financed at premiums. We've never discounted ourselves. We have a special asset to create a $1 billion company. We didn't want to give it away for cheap, but we think now that institutions will start coming at us with better offers. Most of the life of the company was trading between 10 to 20 cents. We've invested $20 million on the project, which means if we would have done that, we would have issued an average of 100 to 200 million shares. Not counting the previous structure. So we've kept dilution pretty tight. When I came in 2012, we only had 120 million shares. So we've did the work pretty much. So that would make it for us. Thank you.